How's it going, everybody? This is BeatTheBush. The stock market right now is officially in bubble territory. Should you try to time the market and try to sell before the crash? Most likely, this is not a good idea. In terms of valuation, it's high. However, there is unprecedented low interest rate right now that props up the market. Today, I'm going to dig deeper into the stock market valuation using the website Seeking Alpha. Before I begin, don't forget to give me a like on this video. It will help me out greatly and it won't destroy your mouse. This video is brought to you by Seeking Alpha. I did almost all my research on this website, and if you're a subscriber, you get exclusive access to this quant rating system. This quant rating system used to be sold to institutional investors for $5,000 a seat. Now you can get access to it and you can try out for free for 14 days to see if it's for you. Check out my referral link down in the video description below. Warren Buffett was a net seller in stocks of over $2 billion the last quarter. This means that he sold more stocks than he bought by $2 billion. Over the past 9 months, he's a net seller of $7 billion of stocks. This sounds like a lot, but it's not a lot of money to him because this is only 2.2% of his entire portfolio. His total portfolio consists of $331 billion and $149 billion of cash. So at this rate of selling, he has to sell for an entire 35 years before he would completely liquidate all his stocks. So if you only look at the headlines, he's a net seller. It's like, oh my gosh, the market isn't going to crash. But overall, he's still holding an enormous chunk of his portfolio in stocks. I want to skip over to how do you value a company because this translates to how you value the S&P 500. Let's say you have some kind of store that makes $100,000 every single year. How much are you willing to pay for it? You're going to start asking questions like, how consistent has the profit been over the past 5 or 10 years? How consistent is the profit going to be in the next 5 to 10 years? Is there much growth in the profits? Is it going to be $100,000 this year and then the next year is going to be $120,000? It's probably unreasonable to pay about $100,000 for this particular business because in just one short year, you're going to make all your profits back. How about $300,000? You're going to make your profits back in 3 years. So this is what's called the PE ratio. The price of the company divided by all the profits that you're going to make every single year. PE ratio. Another interesting example I like to equate this to is solar panels. Solar panels requires a huge upfront cost, and generally ROI is about 15 years. So the electricity or profits that these solar panels are going to make over the next 15 years is going to pay for itself. So you can kind of think of buying solar panels as paying a PE ratio of 15. If let's say you use the same PE ratio for this particular company that pays out $100,000 in profits every year, you're going to pay $1.5 million for this company. You have to wait 15 years before you get your money back if the profits doesn't grow year over year. Now, if you look at the industry as a whole, the PE ratio varies by industry. Usually the less growth, the smaller the PE ratio, and it usually ranges between 10 and 40. But for crazy companies like Tesla, right now, they're around 400. Currently, the S&P 500 has a Shiller PE ratio of 39. The Shiller PE ratio is the same thing as the CAPE ratio. It stands for cyclically adjusted price earning ratio, which just means they average some data over the past 10 years just to smooth things out a little bit so there's not as many spikes in the data. Right now, if you buy the S&P 500, you are paying a 39 multiple for the company as a whole, which means if the profits of all the S&P 500 companies holds constant, you're gonna have to wait 39 years before you get your money back. Now that's a big if because the companies are growing year over year, so likely you're not gonna have to wait 39 years, maybe 20 years. But look at the historic median of the Shiller PE ratio, it's 15.86. By this metric, it's overvalued by 251%. If let's say the S&P 500 revert back to the median, this will represent a 60% drop in the stock market index. An author by the name of John Kingham on Seeking Alpha made this really nice rainbow chart illustrating the valuation of the S&P 500. You can see right now in 2021, we are in the red. In 2008, it was really undervalued. In the green, and if you look back a little bit more in the .com era, it's over the red. So you can kind of say right now, things are a little bit expensive. Of course, if the stock market prices ever drop, it's never going to drop right to the median and stay there and always hover around there. What it always does is crosses it, overshoots it, and then it always fluctuates above and below the median instead. So is it time to sell? Maybe. Probably not, because it's really hard to time the market. What you might end up doing if you sell right now is you're gonna watch the stock market go up for the next 2 years. When the stock market is frothy, it usually remains very frothy for an extended amount of time. The current valuation may just hold and even accelerate for the next 2 to 4 years, at which time the stock market might double again. You're always going to have some doom and gloom articles out there saying the next 10 years, you're not going to make any gains at all. But as I say, the people that make the best returns are the people that are dead. This is just a lore, but it does make sense because then you're not emotionally affected and tempt you to sell. Another article on Seeking Alpha talked about the QQQ. Be prepared for the biggest tech rally in your lifetime. Illustrate how we may be in the greed phase and hence see a rapid increase in equities. Here's a nifty chart from that article in log plot. It compares the dot-com bubble to where we are today. If you look at the dot-com plot, it has an upper and lower plot of straight lines. In a log plot, straight lines are actually exponential. So you have the stock market churning all along at a steady pace, and all of a sudden the growth accelerates and you get media attention. This is a breakout of what it normally does, and you have this for a while, and all of a sudden the growth accelerates. This is what's called the greed period because people are just piling in. People are seeing other people making a lot of money. It's like, hey, this is FOMO, greed, whatever you want to call it, euphoria. And then if you look at where we are today, we also have an upper and lower bound of strong institutional growth. You just keep on churning. There is a steady pace of buying. Again, keep in mind, this is not a linear growth here. This is exponential. We currently broke out of these trend lines, and there's extra media attention of the high flying prices of the S&P 500. Right now, we're entering the greed phase, which will last between 6 months and maybe 2 years or 3 years of this extended growth, and it's gonna feel like money is raining. I estimate it's gonna last about 2 years, but trying to time this is next to impossible. No one knows when it's ever gonna pop. It's kind of like this, and I've been guilty of trying to time the market, but think of like a volcano and it's about to erupt, right? It looks like it's gonna erupt, but you're standing around waiting for it to erupt. You stand around for a couple months, it doesn't erupt. When is it going to erupt? Trying to figure out when it is going to erupt is kind of like trying to figure out when the stock market is going to burst. The best bet is, if you are in equities right now, is just to hold long term. All I'm saying is right now it definitely is a little bit frothy. If you do sell and you want to time the market like Warren Buffett, you might want to only do it to a small percentage of your portfolio. He's only selling less than 1% every single quarter. If you have a $100,000 portfolio, that represents only selling $1,000, not $10,000, not half of it, right? Only less than 1%. Hope you guys enjoyed all these nice charts from Seeking Alpha. Check out their free 14-day trial and their quant system of rating stocks. If you guys are interested, check out my referral link down in the video description below. Don't forget to give me a like on this video and subscribe for more. Thanks for watching.